Internal Revenue Service IRS tax news. Most retirees must take required minimum distributions by December 31st. IR 2021-245, December 8, 2021, Washington. The Internal Revenue Service today reminded retirement plan participants and individual retirement account owners that payments called required minimum distributions, there's a link to that here, must usually be taken by December 31st. Required minimum distributions, RMDs, generally are minimum amounts that retirement plan account owners must withdraw annually starting with the year they reach 72 or, if later, the year they retire. However, if the retirement plan account is an IRA or the account owner is a 5% owner of the business sponsoring the retirement plan, the RMDs, the required minimum distributions, in other words, must begin once the account holder is age 72, even if they're still working. RMDs, required minimum distribution amounts not timely withdrawn from the accounts, may be subject to penalties. So obviously, when you put the money into these types of retirement accounts, the reason you do so is to get a benefit at the point in time you put the money in. And sometimes this can be a little bit confusing because sometimes people get the idea that the only way to save for retirement is to put money into a retirement plan like a 401k or an IRA or something like that that is qualified, as a retirement plan in the sense of the tax code. That's not generally the case because obviously you could put money into any kind of area that you're going to be saving for retirement. The reason you put it under the umbrella of a 401k plan or an IRA or something like that is because you're going to get a tax benefit. And when you put it into a traditional type of plan, that tax benefit happens at the point in time that you put the money in, and you basically are going to then be paying taxes when you take the money out, which means you have a deferral of the tax in essence. That's the general reason for the types of plans. That's the incentive that the government gives for you to put the money under this kind of umbrella. Otherwise, you wouldn't put the money under that kind of umbrella because they're restricting your money. You can't take it out earlier or else you could be subject to penalties and so on. So the only reason why you would actually do that is because you're getting some kind of benefit from the IRS, from the government, that being the tax benefit when you put the money in. Now, the government wants to get paid at some point in time. You're basically deferring the tax. So at 72, they're basically saying, hey, we want you to start taking the money out at this point in time. You've deferred the tax long enough. Now we want you to pay the income the income tax on it. And the way they do that is to make you take it out. So even if you don't need the money at that point in time, they want you to take it out from under the umbrella so that you are now subject to the tax at that point in time, and therefore you're going to have to pay taxes on it. So that's kind of the general concept. So obviously at that point in time in someone's life, you got to be aware and plan for these minimum distributions when you think about your tax planning strategy. This can be difficult for people that even if you've done quite well, that all your income comes from like a W-2 type of income throughout your working career, in which case the taxes kind of work themselves out for the most part because the withholdings are withheld, and usually the withholdings are going to be enough to cover your tax obligations. And then of course at the point of retirement, when you start to take the money out of your retirement plans, then you need more tax planning, which you might not be used to. Some people might not be as used to during their career because they hadn't had to worry about it so much. They just had the withholdings. When you start to take the money out and you've got your different types of areas where the money is, then and including these retirement plans, which are now subject to taxation, then you got to think about how you're going to be pulling the money out and do some tax planning, possibly more tax planning than you had during the working years. So in any case, individuals who reached 70 and a half in 2019, the 70th birthday was June 30th, 2019 or earlier, did not have the required minimum distributions, the RMDs, due for 2020, but will have to take one by December 31st, 2021. Individuals who reached 72 in 2021 and their 70th birthday was July 1st, 2019 or later, have their first RMD due, the required minimum distribution, on April 1st, 2022. The required distribution rules apply to owners of traditional individual retirement arrangements, those are the IRAs, owners of traditional simplified employee pensions, the SEPs and IRAs, owners of savings incentive match plans for employers, that's the simple IRAs, and then the participants in various workplace retirement plans, which include a 401k, the Roth 401k, the 403b, and the 457b plans, depending on the type of organization and the type of plan they have set up within that organization. These are all similar in nature in that you have the same kind of idea. There's differences to them, of course. Some are more simplified and whatnot and are better for certain areas, but you have the concept of the incentive to put the money into the plan, at least from a tax perspective, that you get a tax benefit, reducing the taxes at the point in time that you put them in. Although the Roth IRAs can be a little bit, different there, but that's the general idea. You're getting a tax benefit from them. That's why you put them into these retirement plans. It's not like you can't put your money somewhere else to save for retirement, and that might be a good idea to do too in your retirement type of planning if possible. But you put them into these plans because specifically the IRS has given you incentives to do so. Although as you put them into the plans, they're also restricting your money in some ways. That's the trade-off of the tax benefits that you're getting. So Roth IRAs do not require restrictions while the original owner is alive. So Roth IRAs are going to be a little bit different in general than the traditional IRAs because you could think of them as kind of being reversed, where in that case, you're not getting the benefit at the point in time you put the money in, but you're getting the benefit at a later point in time. So you're in essence paying taxes when you put the money in, and then when you take the money out, you're not paying taxes at that point in time. And therefore, you can see why the government is not quite as concerned with the Roth type of IRAs in that case, because you already paid the tax obligation up front. That's the point of the Roth IRA. Whereas the traditional ones, you didn't pay up front, and you're going to be paying the tax obligation when you take the money out. So that's why they want to pressure you to take the money out at some point in time, so that they can hit you with the tax at some point in your life, right? That's what they're looking to do. So an IRA trustee or plan administrator must report the amount of the RMD, required minimum distribution, to the IRA owner. An IRA owner or trustee must calculate the RMD separately for each IRA owned. However, they can choose to withdraw the total amount from one or more of the IRAs. In contrast, RMDs required from workplace retirement plans must be taken separately from each plan. So you might have, if you have different IRAs, basically you might have the question is, do I have to take my full distribution from each individual IRA? Because that can be somewhat burdensome in my planning strategy. Or can I take it from one IRA? So you might have some more flexibility if you have multiple kind of IRAs outside of your work IRAs. If you have a 401k plan or something like that, 403b or something, then you might be more restricted and you have to you have to take the required distributions from the plan. So not taking a required distribution or not withdrawing enough could mean a 50% excise tax on the amount not distributed. Woo! The RMD is based on the taxpayer's life expectancy and their amount balance. Often a trustee will use Form 5498 IRA contribution information, there's a link to that here, to report the RMD, required minimum distributions, to the recipient. For most taxpayers, life expectancy used to calculate the RMD is based on Uniform Lifetime Table 3 in publication 590B, distributions from IRAs. There's a link to that here. So you might say, well, what is the required distribution? They're going to try to figure out how long you're likely to live based on these actuarial tables and whatnot, and then try to determine what you should then be paid or distributed based on those actuarial tables to determine how long you're going to live and so on. So you can look up that information and dig more into that if you're interested in it. So individuals can use online worksheet on irs.gov to figure the RMDs. There's a link to that here. The 2020 RMDs, required minimum distributions. An IRA owner or beneficiary who received an RMD in 2020 have the option of returning it to their account or other qualified plan to avoid paying taxes on that distribution. So they made some exceptions for 2020 because everything was crazy in 2020, so they did weird stuff. And now you would think we're getting back to the norm without the weird stuff, but you never know. We'll see what happens. A 2020 RMD that qualified as a coronavirus-related distribution may be repaid over a 3-year period or have the taxes due on the distribution spread over the 3 years. Now, they gave some, if you have a financial difficulty, which could have, of course, been the case due to a coronavirus downturn in the economy and so on, then your thought process would be, well, hey, I got all this money in my retirement plan. Can I take it out of the retirement plan so that I can use it instead of taking out a loan or something like that. If I'm in need, it's my money, but now the money, of course, is locked up because you put it in the retirement plan because you wanted to get the tax benefit of doing so, and now they locked up the money to some degree. It's not completely locked, but you get penalized and so on if you take it out. So then they kind of, under certain conditions, possibly coronavirus-related conditions, they might allow you to take the money out instead of taking out a loan and so on and so forth to deal with emergency type of situations, and then allow you to put it back in within the recap period, the 3-year period, without having penalties. So if you took money out under those conditions, then you'd like to put it back in so that you don't get penalized and so on for the early withdrawal of the money. So a 2020 withdrawal from an inherited IRA could not be repaid to the inherited IRA, but may be spread over the 3 years for income inclusion. IRS online tools and publications can help. Taxpayers can find frequently asked questions, forms, and instructions in easy-to-use tools on irs.gov. There's a link to those FAQs here, FAQs regarding required minimum distributions, individual retirement arrangement, IRAs, coronavirus relief for retirement plans and IRAs. There's links to that wonderful reading material here, and there'll be a link to this in the description.